What a dismal week we've just witnessed. The S&P 500 posted its second consecutive weekly decline, closing down 0.61% at 7,411 points, while the NASDAQ continues to take the absolute brunt of the damage. Face reality. Geopolitical tensions in the Middle East are escalating, driving crude oil toward the critical $100 a barrel mark. As if that weren't enough, skepticism is growing regarding the return on investment for the gargantuan capital poured into artificial intelligence. This week's earnings from Alphabet and Tesla served as an ice-cold shower for investors, revealing colossal capital expenditures without any guarantee of immediate profits. And let's not forget the Federal Reserve meeting next week. With energy prices threatening to reignite inflation, the Fed won't hesitate to keep interest rates higher for longer. Caution wasn't just recommended this week, it was vital.
You always see the glass as half empty. Despite this convergence of headwinds, the market is showing a level of resilience that I find truly remarkable. This isn't a crash, it's simply a very healthy sector rotation. While semiconductor and tech stocks take a well-deserved breather after an unprecedented historic rally, investors are rotating into defensive, undervalued value stocks. Just look at traditional giants. Companies like Verizon and Intel reassured the market with solid quarterly results, driving the Dow Jones into the green on Friday with a 0.5% gain. Furthermore, looking at this week's broader economic indicators, overall inflationary pressures are continuing to cool down. This gives the Fed all the breathing room it needs to maintain a favorable rate hold at its July 29 meeting, which the market will undoubtedly welcome.
You are completely ignoring the underlying nervousness. Look at the tension in the bond market. Treasury yields are creeping up again, pushing up borrowing costs for both corporations and consumers. On top of that, ongoing global trade and tariff uncertainties are casting a thick fog over second-half profit margin expectations. Analysts are already starting to revise their earnings per share estimates downward. Consumer sentiment is slipping, and valuations across major tech caps remain historically overextended. What you call a healthy rotation is merely the beginning of a much deeper correction that the market is stubbornly refusing to price in.
You are drastically underestimating the power of market liquidity and the balance sheet strength of corporate America. These minor technical pullbacks are fantastic buying opportunities for anyone investing with a long-term horizon. Operating margins remain historically high, the labor market is holding firm, and the adoption of AI beyond short-term speculative hype is already generating real productivity gains across multiple industrial sectors. This temporary July lull is simply setting the stage for the next leg up in the bull market. The fundamentals remain rock solid.
Time will tell, my bullish friend. But for now, wrap up your portfolio and tread carefully.
Indeed. Until next week, keep your eyes on the charts and stay resilient. Goodbye everyone, and happy investing.